Hello and welcome to the Finance Quarter. I'm Andrew Robertson. The financial crisis in Europe has put the bond market well and truly in the spotlight, with interest rates on Greek government bonds, for example, well over 20%. But what is a bond and how does the interest rate mechanism work? A man who knows is Dr. Stephen Nash from fixed income brokers FIIG Securities. Stephen, what is a bond and how do they work?
Well, the first part of a bond is what we call a coupon payment. It's equivalent to a dividend payment made by an issuer of a share. However, it's typically fixed, so the issuer can't vary that coupon payment. So for a share, for example, you might be receiving 4% at one time and then that could drop. But with a coupon payment, it's fixed. So typically it's fixed at, say, a market rate of around 6%, for example, and typically paid twice a year, semi-annually. So you get your first 3% in the first 6 months and the second 3% at the end of that year. The second part is the face value, which you get repaid at the end or the maturity of the bond. And if the issuer can't pay those coupons or the maturity payment, it's called a default, and then certain proceedings occur.
So that's what we're seeing in Europe at the moment, the threat of countries defaulting.
Yes, in Europe, the market is very concerned about individual countries not being able to have sufficient money or capital to pay those coupon payments or, in fact, the maturity payments. And in some cases, for example, in Greece, there's been what they call a haircut on the payment of those bonds. So instead of receiving $100 at the end of the bond, as you typically do, you might receive $75, for example.
Many people who buy a bond don't actually hold it to maturity. They trade it in what's known as the secondary market. How does that work?
The secondary market is where once the bond is issued, which we call the primary market, the secondary market looks at the bond in terms of what's going on in the funding market. Firstly, what the RBA might be doing, whether it's easing policy or tightening policy. So, for example, if the RBA is perceived to be easing policy, the bond price will typically go up or the interest rate will go down as the funding level goes down. For example, if a bond was issued at 6% and the RBA cash rate was at 6%, that bond would probably trade at par. But if there was a perception that the RBA could cut rates to 3%, the yield on that bond would typically rally, all else being equal, down a little bit, maybe down to about 4%, and the bond price would go up. The second thing that really affects bond prices is the perceptions of credit of the issuer. For example, GE, for example, might issue a security and there may be perceptions of a change in credit quality, for example, a downgrade of that credit. If that was to occur, the yield on that bond would typically go up, all else being equal. And that's what's been going on in Europe as well. As perceptions of the credit deteriorate, the yield typically goes up.
So just in very simple terms, if you have a $100 bond paying 10% a year, that's $10 a year. But if the price of that bond falls to $50, then the effective interest rate is 20%.
That's roughly what it is, yes. It really really depends on the initial price of the bond. But basically, yes, as the price falls, yield goes up.
But the important thing with bonds is that the dollar amount of interest doesn't change, even no matter what the effective rate of interest is.
Yeah, the secondary market yield is really, that determines what price you pay for the individual bond. But the underlying coupon payments, as we mentioned before, and that redemption or final payment remain unchanged. So that really only variable you've got is what the secondary market yield is you buy it at. Yeah.
So is it the effective interest rate in the secondary market that determines what interest rate you'll have to offer if you want to issue some new bonds?
Well, if you had if an issuer had an issue that had issued at, say, 8% with an 8% coupon, if interest rates had fallen to 6%, for example, the new issue would probably have a different coupon. Typically, bonds are issued at what they call par, so the coupon typically equals the secondary market or the primary yield. However, there are some issuers that will issue bonds at higher than par levels, but typically bonds come on at par, so they'll probably issue a new bond at par, so they issue it at the new coupon level of 6%.
Stephen Nash, thank you very much for explaining that.
Thanks very much.